Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.1, which is up just one tick from last week's 6.09. Not too much has been going on in the market, but we did recently have an FOMC meeting, so we're going to get into that and everything else that's driving the market. So let's get on into it. All right, back over to the US 10-year. As you can see, we broke out of this kind of price ceiling that the 10-year was in, which was sitting at a 4.215. Not great news for the 10-year. Luckily, mortgage rates haven't really caught up to this, and whenever we look at the 30-year fixed, what we're doing is pulling the average of applications. And I don't even know if those are closed loans. We don't know that data might be skewed in the sense that there could be discount points. There could be other reasons, right? Some lenders could have a tighter spread than others, but typically there's a spread of 1.5 to 2% with the 30-year fixed rate. And that's from this US 10-year yield, right? So luckily, I think that just with demand where it is right now, lenders seem to have tighter spreads, so they're not making as much in order to get that business. That's what it appears to me to be. And I don't know, maybe if you're a lender out there, you can correct me on that. But we see this 10-year, and it's mildly up, right? Like this is about like 70 basis points. Yeah, about like 4.2, maybe like 60. So, yeah, about like 4.214-ish. And right now it's sitting at a 4.274. So, it's not crazy how high it's gotten, but certainly it doesn't seem like, at least on applications, the 30-year fixed has caught up to where the 10-year is, which is good, right? And we just, hope it stays that way. It would definitely help to bring interest rates down if this 10-year was down, but that is not the case. And we can look at the bond market and see the bond market has been slowly selling off, and that's why we get this rising 10-year yield, okay? So let's take a look at the economic calendar. Last week we had the FOMC meeting, and as everyone expected, it was a pause. The press conference overall, I would say is pretty good. I think that Jerome Powell always says that the Fed needs to deal with the data as it comes in, so I don't know if I would say it was overly dovish or hawkish, right, in the sense that I don't know if really they were leaning one way or the other. I know there's a summary of economic projections that you can find where you can see the edits and the changes. At one point with the summary of economic projections, I want to say that they were a little bit more concerned about a weakening labor market, and that was why there was a push for interest rate cuts, in order to help the labor market. It looks like, according to, I'm pretty sure Powell was discussing in the press conference, that the labor market appears to be strengthening. So let's take a look and see what the probabilities. I think there were two potential. Yeah, I mean, there still looks to be about two rate cuts in 26, one in June and then one in October. I want to say it might have even been where this rate cut got bumped up, but I would have to go back and look at an old episode. And then none for 27. I do know that Trump's nominee for the Fed chair after Jerome Powell's term is up is Kevin Warsh. And from what I've heard is that he is very big on Fed independence. That was a pretty big talking point. And if anyone owned any gold or silver, you probably saw, the price of gold and silver and copper, all metals in that realm. I mean, it had just skyrocketed, like parabolic, right? How high metals had gotten, and that was due to concerns over a Fed that is controlled by the executive branch of the government. So Kevin Warsh ostensibly is it for Fed independence, which brought all of those metals back down. I think like silver crashed like 30% when Kevin Warsh was announced. So pretty crazy stuff. Anyway, so let's get back to it. Anyway, that's just to say that right now, I think it is data dependent. We still need to keep an eye on inflation. I think that that's going to be the big thing for interest rates that we need to keep an eye on. Like so Friday, January 30th, we saw core PPI and non-core PPI. Just in case you need a reminder, PPI is the producer price index. So this looks at from a producer standpoint rather than a consumer standpoint, what inflation is looking like. What are the prices looking like? And this was up 0.7%, which the forecast was 0.2%, and previously it was 0%. So inflation, at least for producers on a monthly basis, is ticking up. So if inflation's ticking up and labor is strengthening, then there's no need to have rate cuts. So that's something to keep in mind moving forward too. Let's see, manufacturing PMI over 50 is an expansion in manufacturing. So let's see, Monday, February 2nd, there appeared to be a decent expansion in manufacturing. This is purchasing managers. I believe they answer a survey. Purchasing managers. So manufacturing does appear to be doing well. And the prices aren't crazy. 59, it was expected to be 59.3. They are expanding though, and higher than previous. What is this loan officer survey? I don't release quarterly. I don't know what this is. Loan officer survey. This is probably something to look at, but we will do it another time. Okay. It is Wednesday, and we had ADP non-farm employment change. Only an increase of 22,000 jobs, so that's actually not great for labor side of the equation. It was expected to be 46,000. And when we look at ISM services PMI, so this is the service side of the economy rather than manufacturing, this is 53.8, which is actually it's an expansion, right? Services are expanding, but not at the same pace as they previously were. I don't believe we will get these unemployment claims. I think the January jobs information, because of the partial government shutdown, is going to be released in February 11th, I want to say. So I don't know if we're going to get this. It says tentative, so probably not. Then we have the University of Michigan consumer sentiment. This is important for getting a read on how people are feeling about the overall economy, and then inflation expectations. Okay. Next week, we do have retail sales. We have JOLTS job openings. So I don't believe this is what we're getting, because I think this is going to be January's information. But we do have core CPI. So this is what we need to keep an eye on. This is, I think, what's going to be a good smoking gun for the 10-year yield and the 30-year fixed, looking at both of those. And then we have unemployment claims Thursday, February 12th. And then existing home sales. So we will keep an eye on existing home sales. Mortgage delinquencies, this is tentative, but this will be interesting to see. Can people afford to stay in those houses, right? All right. That is all we have for you this week. And like I said, 6.1 up from last week's 6.09. So if anyone has any questions, comments, or concerns, reach out to us at 877-TEAM-MBL or visit us at www.mortgagesbylender.com. All right. Have a great week, everyone. Bye.